Jon Wellington. I work for Lane Gorman Trubitt, where Donna used to work. Hello. Full service accounting firm. We specialize in a bunch of different industries, including the construction industry. I personally, I'm actually an attorney, not a CPA. I'm practicing for 27 years now, and been with LGT for almost 11 years. And as you may or may not know, sales tax in the construction industry in Texas, there's a bunch of quirky rules, and so I'm here to basically make sure you kind of understand the basic rules and then the quirky rules. And I'm here for you guys. This is intended to be for your benefit. So if anyone has any questions, comments, war stories, please raise your hand. Please feel free to speak up. I'll probably speak for just a touch over an hour or so. I'll assume we'll just kind of go straight through, but if people are getting antsy or if you like we need a break or anything, again, please just speak up or speak now if you don't like that plan. But otherwise, I'll kind of just get into it. So this slide is basically a disclaimer saying can't rely on anything I say for the next hour, but definitely feel free to reach out to me to confirm anything that we talk about today. So here's kind of the agenda. I'm not going to go through all these topics because some of them are, I can kind of go on for a while. Just want to make sure everyone kind of understands how this, everyone here is probably in a different role, or I don't know what roles you all are in. So just make sure we all are kind of starting from the same, we all understand the words we're going to use in the presentation. Talk about Texas specifically, and then the construction industry specifically, and then some other topics depending on how much time or interest you folks have. So sales and use tax. So probably everyone in conversation, we just talk about sales tax. When you talk legally, we're really talking about sales and use tax, which use tax piece we'll talk about, but just a little bit less kind of common or understood. So if you're looking for a definition of what exactly is sales tax, basically a tax paid to a governing body for the sale of some taxable good or service, right? Makes perfect sense, or makes sense enough. In Europe they have what's called a VAT, a value-added tax, which is a little different because that in theory is imposed on every transaction. So if you're reselling an item, from a distributor to a wholesaler to an end user, there'd be multiple transactions. In theory, a VAT might apply on all those transactions.
Everybody is going to get a copy of all these slides. There were a lot of slides.
It's too much to print, yeah.
Yeah, you'll get a copy of it. You don't have to take pictures.
Yeah, so, sorry, any of that. But, you'll have a lot more slides than I hopefully will. I'm not just going to read all the slides. So sales tax in theory should only be paid once, right? So if you have a situation where you paid tax to a vendor and you collected tax from a customer, one of those things was probably wrong, and either there's a refund opportunity, for one of those parties involved. Who's responsible for sales tax? Everyone's kind of used to the common situation. You walk into a store, the retailer charges you tax, and you pay him tax. Well, technically, the tax is on the transaction itself, but the comptroller can go after either party for the tax. So they could go after the retailer, or the contractor, or they could go after the customer, the project owner. If it's the type of situation where you should have collected tax from a customer and didn't, if an order knocks on your door, they don't care what you did, right? They just want their money from you, and you may very well have every legal right to go after your customer for tax. And of course, that carries its own, complications or reasons why you may or may not want to do so. So the comptroller could go after either party. That's what's known as joint and several liability. Use tax is basically just the flip side of the coin of sales tax. So use tax is assessed upon tangible property typically that's purchased and then used in a state where no sales tax was paid to that state on that property. So in other words, the most common situation is you purchase something that should have been taxable, but they didn't collect tax for whatever reason, and there might even be valid reasons. But nonetheless, their failure to collect, again, wouldn't remove your obligation to pay the tax, so you would owe use tax where contractors often deal with use taxes. All right, I have a job in Oklahoma. I'm now going to ship, $1 million of my equipment into Oklahoma. Do I owe Oklahoma use tax because I'm using this property in the other state? And spoiler alert, the answer is probably yes, but they will give you credit for taxes paid to Texas on that equipment. So that gets real complicated. I'm going to touch on kind of multi-state, but we're here to talk about Texas. I help clients on a multi-state basis. A lot of states, the typical norm is a contractor pays tax on all their purchases, and they just don't collect tax from their customers. That's kind of the majority rule for most states. But again, just like Texas, there's a bunch of quirky states out there. Arizona's got this quirky prime contractor tax and all these various things. So don't just assume what I just said, but nonetheless, that's kind of the default in most states. So here's just some other dialogue about use tax, but I don't really think there's anything here that really we need to go over here unless anyone has any questions. So here's how the language reads in the Texas statutes with respect to this stuff. For sales tax, the tax is imposed on each sale. For use tax, the tax is imposed on the storage, use, or consumption of something in the state. The rates are the same. Kind of all the various mechanisms are the same. You report use tax to sales and use tax return. So there's some quirks in there if it's used for sales tax about what local taxes do or when the tax is due itself. But by and large, they're really kind of, you can just think of them together, right? If one is owed, then the other, if tax is due, regardless of what you call it, it's not really going to change much. Just to give you a sense of how important sales tax is in the world, when I talk to clients, usually the annoying stuff is like property tax, franchise tax, things that are irritating. But when it comes to bottom dollar, it's sales tax that kind of, sales tax kind of rules the world. And that's kind of the norm in most states, except states without a sales tax. In Texas, these are the most recent figures. So last year in 23, sales tax made up about 50% of the revenue that the tax revenue that the comptroller brings in. So these aren't exactly in order, but you can see franchise tax is what, like, 1/7, something like that. So it's really sales tax that drives the comptroller's revenue and their funding, and therefore most auditors out there are sales tax auditors as opposed to other tax types. I mentioned, most states have sales tax. There's 5 states that don't. The little mnemonic that us practitioners use is NOMAD for those 5 states, NOMAD. They're not the biggest states in the world, so usually not too big a deal. And then just from a compliance perspective, in Texas, you just pay sales tax to the comptroller. In other states, it can get even more complicated where you actually have to remit and register directly with localities, like a parish, or in Colorado, what they call home rule cities. So again, and then some states, we would all call it sales tax, but they have different names out there. They're gross receipts taxes, transaction privilege taxes. Some of them, they tax everything, including services. But big picture, that's kind of the lay of the land, throughout the U.S. I'm going to skip over this stuff. It's not terribly relevant to contractors, but if you also have a business, so a contractor typically means, well, we'll get to it, but basically, you're doing the job, you're a contractor, but you might also be selling materials sort of as a side business, if you will. Someone might be able to buy lumber from you without having to have you install it. So when you're selling just stuff, right, without any installation, you're just like anyone else selling widgets or fill-in-the-blank stuff, and then all those types of rules, fall on you. And so if you're selling stuff throughout the U.S., historically it used to be if I didn't have any people or property in your state, if I sold stuff to customers in your state, I didn't have to collect sales tax, right? So most people are old enough to remember beginning of Amazon, used to buy stuff online. There was no sales tax. It was great, right? It was like 8 1/4 discount. That's because Amazon didn't have any physical presence in Texas, or at least that was the argument, right? So fast forward many years later, there was a Supreme Court case called the Wayfair case, like the website, And now the new rule is basically, and this is sort of a, again, don't quote me on it, but generally speaking, you don't need to have what's called a physical presence in a state for them to require you to collect tax. You typically just have to have over 100,000 in sales in the trailing 12-month period, and then they'll say, all right, you have what we call economic nexus and a filing requirement. So again, that's not really going to come up if you're doing a construction project, right? You're always going to have a physical presence there. But if you also have part of your business where you're just selling stuff straight up, just delivering stuff into other states, if that exceeds over 100,000 in a particular state, be aware you might have a sales tax collection responsibility, which means you have an exposure out there if they come after you. All right, enough of that. Let's just talk about Texas more specifically. Texas, like most states, says when you sell a piece of property, tangible property, that is taxable unless there's an exemption or some other reason why it shouldn't be taxable. If you're performing a service, it's the reverse. The default presumption is a service is not taxable unless Texas specifically taxes it, what we call an enumerated service. So somewhere out there, there's a statute, and it basically lists A, B, C, D, E, F, G, and it lists all the taxable services in Texas. Unfortunately, some of those relate to construction, and we'll get to it. But big picture, that's sort of the exception, not the rule, for a service to be taxable. So basically, like I said, sales are taxable unless perhaps what you're selling is taxable, whoever you're selling it to is not taxable, or however they're going to use the stuff is not taxable. So just to clarify a little bit, the government, schools, churches, that sort of thing, those are, when you sell to them, they're exempt because of their character. Manufacturing equipment is exempt. Certain food, medicine, stuff like that. So some things are just, not taxable because of the character of what it is. And then if you buy something for resale, which is very relevant to this conversation, that is also exempt, right? Sales tax shall be imposed once. So if you have a sale going down, 5 different parties, tax should only be imposed on the ultimate consumer, and everyone else would have given resale certificates in theory. There's something you could have with the state known as a direct pay permit. I don't know if any of you have that. A direct pay permit typically applies to somewhat larger taxpayers. I forget the number. I think if you have like over 80,000 in tax a year, you could get a direct pay permit. I forget. The point there being, if you're a taxpayer, we'll get to it, but when you buy stuff, you might not know if it's going to be taxable or not taxable because you don't know how you're going to use it. So what you can do is have a direct pay permit, in which case you give a certificate to your vendors and they never collect tax from you, and you basically just figure it out yourselves, right? This stuff is exempt unless or until I use it for a taxable reason and I pay tax at that point. So it kind of takes the burden off knowing exactly what's going to apply at the time of purchase, and it gives you the time to figure it out if and when you use it in a taxable way later. So again, we'll talk about this more, but in the sales tax world, if you ever get audited, the most important thing is documentation. You can have the greatest story in the world, but if you can't prove it, they just truly do not care. So a sales tax audit, documentation, documentation, documentation. Yes? In an audit, I was going to go through audits later, but big picture, just in case people leave by then or what have you. So, if an auditor knocks on your door, obviously it's kind of my self-interest to say, yeah, you should hire a representative to help you. But typically what you'll find is, I have several reasons. One is probably most of you work for a business that's owned by your boss, right? You're not working for AT&T, you're working for Jim. And, if some auditor knocks on the door and starts telling you that we don't think Jim's been doing things right, Jim could take that personally, even if, no bad intent, just mistakes happen, whatever it is. So, you don't want any emotion involved in the audit, right? You don't want an angry business owner who's, getting upset with either you or the auditor and, kind of making things a little bit more difficult on that side. If you deal with a representative, typically the auditor will not hang out with you, like they won't come to your premises. And so you never know what they'll hear, you never know what they'll see, and that sort of thing. And also, you know, when they ask you for documentation, they might ask for X, but you might have X as part of a larger report. And if you just give them the larger report, you know, you might be giving them something you don't want them to see that leads them down, you know, exploring something you didn't want. So you kind of want someone who's kind of vetting all the documentation before it goes to the auditor. You kind of want someone to kind of clean up your arguments, to present them to the lawyer and things, to the auditor and things of that nature. So that would kind of be those would be the main reasons why I would typically recommend it. So if you did have a sale that would have been taxable and you're saying, no, it's exempt because X, Y, or Z, they'll say, all right, if you give me the exemption certificate, you're off the hook. Well, you got to have that exemption certificate, right? And so there's various kinds of exemption certificates. If you look up the form, if you Google the form, Texas Exemption Certificate, you'll see there's 2 pages. One is an exemption certificate, that's the name of it, and the other is a resale certificate, which also entitles you to an exemption, but obviously is just related to resale. So an exemption certificate itself is typically given by someone who is not using it for resale and is otherwise exempt, typically church, or you're using it for manufacturing or various other things. And that's all well and good. The real important part of this is a resale certificate is only valid if they have a valid taxpayer number. So typically, they can't have a taxpayer number from another state, but let's just assume you're dealing with a Texas customer. If a Texas customer gives you a resale certificate, you'll see there's a blank for their 11-digit taxpayer number. And if that's blank, or more importantly, this is public information. You can go online, go to the comptroller's website and look it up. If they don't have a sales tax number, then that resale certificate is garbage. It's worthless. It's useless. Doesn't help you. So even if you have, again, I'll talk about it more, but if I don't, if you're in the, you know, if you're customarily collecting resale certificates from your customers, you should have a process in place to make sure that they all have a valid taxpayer number on it, as well as, you know, be signed and have their name and all that good stuff. The critical part is that they have a number at the, you know, at that time, you know, at the time of the transaction. So even if they get registered 2 years later, that doesn't help you with the transactions prior to their registration. I think that's about all I got there. So I think we've talked about most of the stuff already. You know, a resale certificate needs to be taken in good faith. So if, you know, if you're selling, you know, a cabinet to I don't know, a car dealership, you know, you should probably know that they're not going to turn around. They're not in the business of reselling cabinets. That's probably for their office, right? So you're supposed to, if you accept it in good faith, it's not like you have to know or prove or follow up and make sure they resell it. But again, it's just kind of common sense and you'll be okay. Similarly, on an exemption certificate, just accept it in good faith, and you're supposed to be familiar with the types of exemptions in your industry. So again, you know, as long as it doesn't, if it passes the smell test, you're fine, even if, you know, ultimately the facts show something differently. As long as you took it in good faith, you're off the hook, and that's good. As you probably know, Texas, basically you pay 8 1/4 everywhere, and that really is a state rate of 6 1/4. And then typically you're paying a 1% city and a 1% county rate. That does vary. But you know, there are places in Texas that are outside of incorporated areas, and so the rates themselves might actually just be the 6 1/4 or 7 1/4. And so if you're shipping goods in Texas, Texas says if you're a Texas-based company and you're shipping something to a Texas customer, you just charge them tax based on where your location is. You're just a retailer shipping stuff. You're providing a service, it can be a little bit more complicated. It might be where the job site is. But for most purposes here, if there is a job in question, then the local tax for any materials used on that job will be based on the job site. So again, if you're just selling stuff without installation or anything, you would use your location as the, you know, the tax rate, and, you know, that's what you'd put on your tax return because it asks all the local jurisdictions. But if you have jobs at different job sites, you know, if you're at 10 different job sites in a month, in theory, your sales tax return will have 10 different, you know, localities where you're putting in your sales, and, you know, if it's less than 8 1/4, then of course you owe less than an 8 1/4. there's a whole bunch of stuff that was going on in the local sales tax arena. I don't think it really applies here. It had to do with, like, you buy a computer from Dell, or like at least a long time ago. So let's just pretend you order something off the internet and they ship it to you from a warehouse. So the question is, what local sales tax should apply? So historically, everything I just told you, you'd say it's the warehouse, right? Well, warehouse isn't really a place of business to Texas. And so other jurisdictions are upset that only these fulfillment centers jurisdictions are getting all the sales tax. And then like Dell would enter. I use Dell just because I'm old and that used to be the thing you do, order them online. But, they were at the heart of a lot of this litigation, like Round Rock and stuff, because then the locality would then say, all right, we'll give you a 1% rebate on all, instead of paying us the 2% in tax, we'll give you 0.5% of that tax back as a rebate if you build your fulfillment center here, and we get all the sales tax revenue. So now there's all these economic development agreements out there, and now Texas wanted to change the sourcing to not where the fulfillment centers are. So you got all this litigation. It's been going on for years. Basically, it's now kind of over, and the moral is kind of what Texas wanted in the first place. If you're talking about a sale inside of Texas and you just receive an order online, they're going to want you to collect tax based on where you ship it to. So again, it doesn't affect you if you're doing a project, but if you're just selling, widgets, lumber, whatever, then everything I just talked about would apply to those types of sales. Sales tax, typically, as long as you owe any kind of decent amount of money, you're going to file monthly. We're sitting here August 1st, so July just ended. Your July sales tax return is due August 20th. If you collect less than $1,000 a year or $1,500 a quarter, then you could be shifted onto a less frequent filing basis. So not a perfect world, but if you're remitting no sales tax, you would just file once a year, which obviously is not so bad. And then if you ever do get audited, there's a 4-year statute of limitations. So if you're a monthly filer, that translates into a 48-month statute of limitations. Typically, if you get audited, instead of auditing you for the full 4 years, they audit you for 3.5 years, 42 months. Let's just kind of skip over this. If you have bad debts and you've already paid tax on some sale, you can get a credit for it, or a rebate, or a refund rather. So that's kind of just big picture. Just wanted to spend whatever that was, 15 minutes, background. Everyone with me so far? Everything makes sense? Everyone knew everything I already said so far, probably, or maybe. So, all right. So let's talk about the construction industry specifically. There's basically these 7 factors, these 7 questions to ask yourself. And if you can answer all these, you'll get all your sales tax correct. And I'm going to go through these in this order, going through it. These 7 factors are basically me translating this next slide, which is a very helpful, and again, so in Texas, the audit manuals, the instructions that auditors actually use, is public information. So you go on the comptroller's website, you can download the audit manual for contractors. And in the back of that thing, there is a 2-page flow chart on taxes and how they should work. I understand none of you could probably read that, so don't worry about it. But basically, I'm just going to talk about this flow chart for the next hour. This is kind of, the black and white. And of course, there's tons of shades of gray, and that's why you all are here. But in theory, whenever you get a question and you don't know the answer, or you're trying to figure it out, if you can kind of mentally or physically just pull this thing up, you go through it, can't go wrong, because this is the same thing the auditors could be looking at when they're auditing you. So for those of you who can't see it at all, this is kind of doing work for a taxable customer, and then the second slide is doing work for exempt entities. So again, I know you can't see it, but I'm going to kind of go through it, in language instead of just the flow chart. The first question, are you a contractor? Well, everyone just assumes yes, but a contractor is actually a defined term of art in the tax code. And it's a long one, but I'll try to sum it up. So this is the definition of a contractor. It's really, if you're doing one of 3 things, you're a contractor. You're building new improvements to residential or non-residential real property, right? So if you're doing new construction, you're a contractor. If you're completing any part of an uncompleted new construction, new structure, that's really the same thing, right? Just you're just making those improvements to another improvement, residential or non-residential. And then this line, if you're making improvements to real property as part of periodic and scheduled maintenance of non-residential real property, so that's its own little section. So we got new construction, and we got scheduled maintenance of non-residential property. And then the third part is repairs, restores, maintains, remodels residential real property. So that's repair of residential, right? So I named 3 buckets, right? New construction, remodeling residential, and maintenance non-residential. So the biggest bucket I did not talk about was remodeling non-residential property. For remodeling non-residential property, you are not a contractor for sales tax purposes. And we'll talk about why that's important. But that might not, kind of make sense intuitively. And that's kind of one of the most critical things you could take out of here is, of course, you're a contractor, but not for sales tax if you're doing remodeling. And remodeling is pretty broad, as we'll talk about. Contractor, general contractor, subcontractor, you're all contractors for this purpose. Okay? Now, some people want to, if you are a contractor, you cannot be a manufacturer. And so, what's important there is you cannot claim the manufacturing exemption. If you bought something thinking you're eligible for the manufacturing exemption, and then you use it for some other purpose, you're going to owe sales tax or use tax. And it's not like if you use it once, you got to pay tax on the whole thing. They kind of divvy it up amongst 48 months. Basically, if you use it, it's taxable on sort of a, each time as opposed to all at once, yes or no. I didn't explain that very well, but the point here is that a contractor cannot be a manufacturer. So why does that matter? Again, because a contractor cannot take the manufacturing exemption. So here's kind of the prototypical example. Here's a contractor, a taxpayer, that designs and installs cabinetry, right? And they also bought a bunch of equipment so that they can make their own cabinetry that they go out and install in their customers' homes, whatever. However, or the moral is because they actually go out and do the installation, they are a contractor because they're doing work on real property. That means they're not a manufacturer. They're not eligible to take a manufacturing exemption on the equipment they use to alter their cabinetry. So, that's a very kind of common hypothetical. So what is the solution? Any ideas on how you could solve this problem? Well, sales tax is very much a form over substance tax. So in income tax, you might have heard like, what's the economic substance of the transaction, or what was really the party's intent? In sales tax, none of that matters, right? So the answer here is you just create 2 companies, one to hold the manufacturing equipment and one to do the installation. And then there's no issue. So even though you as a group are doing both these things, each individual taxpayer, is clean, right? This guy is a contractor, and then this guy is eligible to take the manufacturing exemption because they're not a contractor, and problem solved. Does that make sense? That's important. We've had that affect a lot of clients in the past. Okay, so are you a contractor was the first question. The answer is yes. You look at the flow chart. The answer is no. We'll talk about that later. Okay. So part of being determined, so here's the second part. Are you doing work on real property or tangible personal property? I don't know if this is often a gray area for you, but it certainly can be. If you're doing work on tangible property, you're not a contractor, right? Because that's not what that definition relates to. So if you're trying to figure out if a piece of property is real or tangible property, you go back to the old Hutchins Masterson from 1877, which of course everyone remembers very well. So there's basically three factors in determining if a piece of property is real or tangible. You can read these as well as I. Has it been annexed into the realty? Would it be damaged if it was removed? Have you adapted the property to incorporate it into the real property? Really the third part is the most important, is what was the intent of the party using the property? Was it intended to be permanently affixed, or is it supposed to be easily removable? So if you could just unscrew something and walk off with it and there's no damage to the wall or something, that's probably not going to be considered real property. So this all sounds easy, but sometimes it's not. So let's talk about pipelines. Is a pipeline real property, or is it tangible personal property? So here was a company, and they were doing work on those pipelines. So of course, if they were doing work on real property, it would lead to one result, and if they were dealing with tangible property, it would just be a taxable repair or install. So ultimately, in this case, they decided that injection pipelines and flow lines were just tangible property, but transmission pipelines were real property. So you can't just say pipeline, right? You got to ask more questions. So I don't know if, again, this is something that anyone deals with on kind of a practical level, but there really is, or can be at least, the question of, hey, I'm not even doing work on real property at all, and what are the consequences from a tax perspective that come from that? All right, so that's the second question, right? Tangible or real property. The third question is, are you doing work on residential or non-residential property? Again, remodeling of residential property is not taxable. Remodeling of, did I say that wrong? Remodeling of residential property, the labor is not taxable. Remodeling of non-residential property is a taxable service. So it's important. So what is the definition of residential property? Any structure, dwelling, used as a dwelling where someone averages a stay of over 30 days. That includes single-family homes, multifamily homes, apartment complexes, and then the associated common areas that go with those types of places. Doesn't include hospitals. It doesn't include most hotels, although you could imagine an extended stay place could qualify. And I'll get to you. And so that's basically the definition of residential. And so if you're not that, then you're non-residential. So that's fairly straightforward. Or multi-use. Well, presumably there's both in there, and ideally your contracts you have either separate contracts, or your contract specifically talks about this stuff, because it's the type of thing where you can do the little bad thing taints the whole thing, and everything becomes taxable. So if you do have mixed use, you're going to have to be able to support or show, that division and what labor was associated with which part of the job. So yeah, it can get complicated for sure. All right, any questions or comments so far? All right, I don't know how yeah, see, I don't know if I've done a great job about the taxability yet, so let me clean that up. So as far as what you said, the materials are taxable. We'll leave aside whether you're collecting from your customer, paying your vendor, because that could vary, but you're correct. So just to step back, any of the materials you're selling, we talked about, right? Tangible personal property, you sell TPP, it's taxable, right? So all the materials are taxable. So really all the complications of the law really revolve around handling the labor. And because the non-residential repair is taxable, you can't, it kind of screws everything up. You can't just make big bright line rules that apply all the time. So when it comes to the materials are always going to be taxable, absent, church, government, whatever. And then the labor, it depends. And then the type of contract you have, which we'll talk about next, will impact, do I collect or do I pay my vendor? Does that helpful or responsive to your question? Yeah. No, I appreciate that. Yeah. So materials are always going to be taxable, unless you got a certificate coming back, basically. So I mentioned only certain services in Texas are taxable. What's relevant here is two things. Texas taxes the repair, remodeling, and maintenance of tangible personal property, which again, if you're doing that kind of work, you're not a contractor, none of those contractor rules apply, but your services are taxable. So repair is taxable. There's a couple exemptions out there, like automobiles. I mean, nothing that's applicable here, but and then also what Texas defines as real property services are taxable, and we'll talk about that in a minute. And then the third thing that's taxable is the repair, remodeling, and restoration of non-residential property. So this is really, what gets most taxpayers on an audit, right? We thought we were doing new construction. The auditor's saying it was remodeling. Now I owe a bunch of tax on the labor piece. Presumably you already handled the materials, but this impacts the taxability of the labor. So here's the relevant reg with respect to repair, remodeling of real property. That was scary there. So basically, if you're doing repairing, restoring, remodeling non-residential real property, you got to collect tax from your customer. Again, you're not a contractor if you're doing remodeling of real property. I know I've said that like 10 times. I'll probably say it 10 more times. So if you think about it, if you're doing non-residential remodeling, the materials are taxable and the labor is taxable. So no matter how you contract for it, no matter what you call it, no matter how you bill it, everything's taxable. So it's easier as complicated as that. Again, residential remodeling is not taxable, so that will be a different story. And just like anything else, if someone can give you a valid exemption certificate for your otherwise taxable remodeling work, great, then you owe no tax. So if you're doing this type of work for a church, they could just give you an exemption certificate just like they could to any other service provider. Well, I'll get to it. It'll depend on the type of contract you have. It's either a separated or a lump sum contract. That's the other kind of really big topic I'll get into. But ultimately, in that relationship, everything I say goes. So one of two things will happen is either you'll have I'll explain more in a minute, but you might have a lump sum contract, and if it's new construction, then you don't collect tax. And if it's a separated contract where your labor is in fact taxable, you would invoice the GC or whoever for tax, and then depending on their contract, they'll either pay you tax or they'll give you a resale certificate. So from their perspective, if they pay you tax, that's the only time tax will be paid. So the answer is it depends, but the theory is correct that should only be collected once, and if you're collecting from your customer / GC, you don't really care what they do, right? But in theory, they're not going to collect tax from their customer because they've paid you. Okay, so what does it mean to do remodeling of non-residential property, real property? To rebuild, replace, alter, modify, or upgrade. This is a real critical point. Any work that's done after the initial finish out is remodeling, even if the improvement has never been occupied. So I think it's the next slide. I'll talk about a mall. It's completely gutted. And then someone came in and did everything in there. That is all remodeling. Everything done after the initial finish out is remodeling. In your head, it might have been a new construction job. This place was never occupied, this, that, the other. So again, you could get yourself in trouble there. Yeah.
Okay, so then if you're doing they have an existing building, they're adding a new onto it section or whatever it is, Is that remodel or is that
Well,
new construction because it's from the ground up?
yeah, I'll talk about that in a minute, but new square footage is new construction. So not a better example, but I had a client who, like Jimmy John's or, that type of restaurant. So there'd be a building, and I know in my office there's like a witch underneath our thing, So that building's there, and there might be no restaurant there. If someone comes in and, basically makes a little Jimmy John's out of the bottom of the building, that is all remodeling. That is not new construction because the building was already there. So might have been no restaurant there, might have been nothing there, absent literally the structure. But that's where, again, at least for them, they got in a lot of trouble. They're like, these are all new restaurants. And I'm like, they're existing buildings, and that was the problem. Partial demolition of existing non-resident real property is taxable. Total demolition is a non-taxable service. There it is. So just keep that in mind. If it's a partial demolition, then it's still remodeling. If it's complete, then it's going to be new construction, or at least not taxable. So for you as not the contractor, but the service provider, if you're doing remodeling of non-residential property, any property you buy that you turn around and sell to your client, you could buy for resale, just like any other resale. And if it turns out you had stuff that you already paid tax on, and you didn't realize you're going to use it for this job, and then you ultimately charge your customer tax on it, then you can go back and get a refund on the tax you paid in the first place because you really had bought it for resale. So there might be some refund opportunities on any equipment, or not equipment, but materials that you paid tax on that you later use and tax your clients on. All right, if you remember that definition of a contractor, there's kind of the three sections. One of them was the maintenance on non-residential property. So I want to expand on that. So it kind of, it is what it says it is, right? There's an exemption for, if you're a contractor, there's an exemption for scheduled and periodic maintenance on the improvements. So what does it mean to do scheduled maintenance? It must be scheduled and periodic work to sustain or support, the continuous operations. You can't be making it better, right? You just got to maintain it. But really the critical thing to take away from this is a very narrow exemption, certainly from the comptroller's perspective. And the real critical part is that it's scheduled and periodic. So it's a little easier to give examples. So examples that are okay, air conditioning maintenance agreements, lighting maintenance agreements, irrigation maintenance agreements. You want to have this all in writing. So yeah, here. So here are some examples from some cases out there. If you're recaulking a building that was in danger of deterioration, that was taxable remodeling because you're not maintaining it, you're kind of making it better. Seal coating of a parking lot. If you did that because it needed it, then that would be taxable. But if you're doing that every 6 months, no matter what, then that would be a non-taxable maintenance. And here's just an example of grease trap cleaning services. That in and of itself is not taxable, but in doing the maintenance, you discover issues that need to be, worked on, repairs that need to be done. Any of the subsequent work would be taxable labor and repairs. So again, this comes up usually in the context of my clients trying to argue it, and it's very hard to do unless you have a written agreement that says we're going to do this kind of no matter what, every so often. And it's worth pointing out that every so often doesn't have to be often. You can have you can have someone who's painting this building every 2 years, whether it needs it or not. Well, that's scheduled and periodic, even though it's still 2 years. It's a long period, but nonetheless, it's periodic. So, any questions or comments about any of that stuff? All right, great. And then there's one other component of taxable services, are real property services. So, what are real property services? Really just kind of a bucket of stuff related to taking care of real property, like landscaping. It's kind of the big one, waste removal. Those are kind of the two big ones that come up in audits and, just in real life, practically. So real property services, again, those are taxable. Kind of the major caveat is if you're doing residential new construction and you're purchasing these real property services for the benefit of that new residential construction, then those services are not taxable. Otherwise, they're taxable like anything else. Again, it's not a contractor, right? It's just a service. It's just another thing to keep in mind. They're mentioned on those flow charts as well. Usually it's landscaping or waste removal stuff. I'm going to skip over this stuff. All right, here's the other big topic. Probably the biggest topic outside of remodeling or new construction is, do I have a lump sum contract or a separated contract? And those are both sales tax terms. Okay. There is no contract out there, then an order has no choice but just to look at the invoices. The contract is the most important document, and that will control over any other documents in determining if it's lump sum or not. And it trumps change orders as well. All right, so what the heck are we talking about? A lump sum contract means you charge your customer a lump sum charge for the job. A separated contract means you separately charge for your labor and your materials. So typically a cost plus type contract, it's a separated contract, and lump sum contract is, I'm going to do this job, we estimate it'll cost X, and yes, there might be change orders, there might be overruns, and that number is not going to be the final number, but nonetheless, we're just going to bill you, a progress bill every so often, or whatever the case may be. But ultimately, a lump sum contract means we're doing the job for a price. And again, a separated contract means we're going to break out our labor and materials, and we're going to show you and charge you for our labor, and we're going to show you and charge you for our materials. So each of those types of contracts has sales tax consequences, and that's obviously the major reason why we care. Lump sum contract means you, the contractor, are the ultimate consumer of anything you buy. You pay taxes to everybody, and you collect no taxes. So that's kind of like the default in other states, or that might just kind of be the default, kind of people have in their head about how the construction sales tax works. So again, lump sum, you are the end user. You, the contractor, the end user, you don't charge your customer any taxes at all. So if you're doing new construction, in theory, you're going to pay sales tax on all the materials you buy, and you would want to make sure that any taxes you're paying to your vendors is reflected in your bid to your customer. That's where you kind of get right? Or that's where you get in trouble, is if an order comes in, it says this was actually a separated contract, and now you're eating the tax. So under a lump sum contract, not only don't you collect sales tax from your customer, but you are specifically prohibited from doing so. And if you do so, you got to give it back to the customer, or you got to give it to the state. So there's no you can never benefit from collecting tax on a lump sum contract. So here's an example, a little bit of a complicated example, but this guy builds fences for residential customers and non-residential customers. And he also sells these fence panels by themselves. So he buys everything exempt, puts them in his inventory, and then when he goes out to a customer, he says, all right, I'm going to bill you a lump sum charge for building this fence. And the way that his proposal comes up with the price is he figures out, it costs me X per panel of, he basically gives these three components of his job on his invoice: materials, installation, and sales tax. Add that all up and you get to the quote that he gave his customers. Okay? So that's how he's operating. Now, so the order said he's performing under a lump sum contract, which he's really not arguing. But because the way his invoices broke out, they listed materials, installation, and sales tax, and I just told you that you can't collect sales tax from a customer under a lump sum contract, So they said he's got to give the sales tax he collected back, and of course he owes that to the state. So he basically ended up eating the sales tax because his lump sum price literally called a piece of it sales tax, and you just can't call it sales tax. So if that number goes into your bid, that's fine. It goes into a contract, that's fine, but you don't want to then invoice the sales tax piece. It's all just part of the larger lump sum price. So that is a pitfall to avoid. Anything called sales tax on an invoice, you could tell the comptroller that was supposed to be a reimbursement, this, that, the other thing. No, if you call something tax, it's theirs. End of story. So you got to be careful there. So separated contract, we talked about separated contract means that you separately state the labor and you separately state the materials. And when that's the case, then you are considered, instead of being the end user of all the materials you buy under a separated contract, you're considered to be a retailer. So you will give your vendor a resale certificate on materials for a separated contract and charge and collect sales tax on materials from your customer under a separated contract. So again, if it's new construction, for example, you have a line item for labor, not taxable. And you have a line item for materials, and you'll collect the tax and remit it to the state. Going back to your earlier point about the materials, well, it depends who's going to actually pay the tax, but yes, the tax is due on the materials, and then presumably, the labor is not going to be taxable under either type of contract. It's just, the way it mechanically works is those are the kind of the two options. Does that make sense? So when it comes to audits and stuff, it gets very, there's just disagreements, right? Your contracts probably do not say, and it might be a good idea for them to say this, but they probably don't say, this is a lump sum contract under Rule 3.291A of the Texas Tax Code, right? So you got to think about what they look like or how you could defend whatever position you might be taking on an audit. And one's not better than the other, right? They're just different. And some of you might do the same type of contract over and over again, and it makes sense, whatever you do, just do it the same every time. Some of you might deal with every issue I brought up so far, right? You might be doing new construction, you might be doing renovations, you might be doing residential and non-residential, and you might be operating under different contracts. So a lot of times I'll speak to like project managers or people who are putting out the proposals to make sure that the bidding process, is correct in terms of making sure you're getting whole on any taxes you may owe, or, that you're making sure that you're not eating any taxes that you could be passing down to a customer. All right. So we talked about remodeling is taxable and new construction is not taxable. So what is new construction? New construction is new improvements, including initial finish out work, creating a building or anything where nothing was before. And we just talked about or touched on additional usable square footage is also new construction. I have some examples. And if you want to argue there was a building there and we tore it down and now it's all new construction after that, you have to demo the whole thing. What Texas, their policy, it's called down to the slab. You got to tear the whole thing down. Otherwise, it's all going to be just new remodeling after that. So under a lump sum contract, right, the labor is not taxable because it's new construction. You would just pay tax on the, the materials. Under a separated contract, you're going to be selling the property to your customers, and so the tax rate applies to the price of the materials in the contract or the price of the materials to the contractor, whichever is greater, right? So you can imagine this scenario in your head. You might be thinking, oh, I know what I'll do for a new construction job. The $1,000 job, I'll charge them $999 in non-taxable labor. I'll charge them $1 for materials, and I'll only owe the comptroller, 8 1/4 cents. Well, the rule says no. You got to at least get the comptroller's got to get at least as much tax as what was due on the price that you paid, right? So as if there was no markup to your customers, the comptroller wants their share, right? So that seems fair, but nonetheless, you know, if you're thinking that way, you can't go around it that way. All right, so here's a bunch of examples on what is new construction. I mentioned finish out work on a previously occupied mall that was gutted. That was all remodeling because the building was already there. Installing insulation panels on the outside of tanks that stored oil products. That was considered to be an upgrade and was not, it was an upgrade, so therefore it was remodeling, repair, and not new construction. New concrete pads is new construction. Dredging, that's making a slab bigger, that's kind of new usable square footage, and that was considered to be new construction. And here's one where they replaced the roof, and they tried to argue that a cone roof, so it added new square footage up there, but the comptroller said no, because that's not usable square footage, that's just, just a cone on top of the building. So a ramp is new construction. New gutters, someone tried to argue was new construction, but that did not work. And then here's sort of a mixed job where it was remodeling and a new construction job mixed up together. But you gotta prove it, right? A lot of cases, you'll feel empathy for the taxpayer and all that, but unfortunately, documentation. So even if it's not talking about certificates, if you're trying to prove something's new construction, you got to have something to prove it. I got one coming up, so lots of examples or hypotheticals out there, and we'll talk about some of them. Here's another one where it was a car dealership that was destroyed in a fire, and so the order basically said that they couldn't really tell if the whole thing was destroyed or if existing walls or joists may have still been in existence. So the taxpayer could not prove that was down to the slab, and therefore they could not prove that it was new construction, and therefore it's taxable remodeling. Here's the thing on pipelines. We're basically, we also talked about is it tangible real property. You could also talk about whether it's new construction or repair or remodeling. So installing a new pipeline is new construction. If you're installing it deeper, just kind of moving it, then you got to have the depth changes substantially. It was new construction. Otherwise, it was remodeling. So the details aren't terribly important. It's really the gist that things that might seem obvious, sometimes they're not so obvious, and you got to keep in mind just these issues and make sure that you're correct in your assumptions. There's just lots of examples out there. Here's one where they're installing pipelines to connect up to wastewater lines for a septic system. So they tear up a parking lot to install a new pipeline. So it's a new sewer line, new construction. Yes, that makes kind of perfect sense. Demolition of the old system. Yes, complete demolition. They tore up this parking lot, but they had to repair it. So those were taxable, things like that. All right, a mixed project. You could have a mixed project in a couple different ways, right? You could have residential and non-residential, or you could have exempt and non-exempt. So if you're mixing both, the whole thing is taxable unless the new construction labor is separately stated. So, how easy or hard that could be, I'm not sure. Here's a typical example or a great example of a restaurant where they're remodeling a kitchen and they're building a new dining area. So one thing is remodeling in theory at least, and the other one is new construction. So you guys got to make sure you can support that distinction. And you've seen a couple times in my slides this 5% thing. Basically, if something's non-taxable and less than 5% of it is taxable, then the whole thing is not taxable. So basically, like a 5% de minimis it won't screw things up for you. But once you cross the 5%, if it's 6% taxable, then it becomes 100% taxable. So that's why you'll see that 5% in there in a few slides. So quiet. All right, so we talked about lump sum or separated. Is one better than the other? I mean, not necessarily. The real critical thing to keep in mind is, for example, if you're working on a manufacturing facility, you need to have a separated contract. Why? Because if you have a lump sum contract, you, the contractor, are the end user of the materials you buy, right? So you're going to buy stuff from your vendor, and then you're going to turn around and sell it to your customer, who is going to give you a manufacturing exemption because it's talking about manufacturing equipment, if you're the one buying the equipment on their behalf. Well, you can't give your vendor an exemption certificate. You can't give them a resale certificate under a lump sum contract, right? Because that's is incorrect. And you can't give them a manufacturing exemption certificate because contractors cannot be manufacturers. And so all of a sudden you're paying tax on what would otherwise be non-taxable materials. So that is one perfect example of why you would have to or really want to use a separated contract. Otherwise, it's really sort of, I'm neutral on the topic. But a lot of clients like to do everything one way for everybody, and obviously can make life easier, and sometimes that's possible, and sometimes it's not. And of course, if you do everything on let's pretend everything was lump sum new construction, then you literally don't even have to be registered with the comptroller for sales tax, right? You're paying your vendor all the taxes, and you don't have to collect anything from your customers. So it's nice and clean. So there's that angle if that was important to somebody. Be good so far? All right. I'm kind of winding down on the main topic, and we could see what else you guys are interested in talking about. So other purchases by you guys, supplies and consumables. When you buy supplies and consumable products, then you typically need to pay tax. If you're operating under a separated contract, you could arguably resell any consumables or stuff to purchase things under resale, but you have to have the title transferring to your customer at the time you take possession, and yada, yada, yada. So it's possible, but big picture, typically you're going to be on the hook for any consumables and supplies that you use in performing a job. Equipment. If you rent equipment to perform your job, or you buy equipment to perform your job, it's taxable. Kind of period. If you're doing work for an exempt organization and you hire some cranes to perform this exempt project, still taxable. It's always taxable. So even if you're doing work for an exempt organization or the government, any rentals or purchases of equipment for your own use is always going to be taxable. One thing just worth noting is if you rent equipment with an operator, typically you're buying a service and you're not renting equipment. So you buy a crane with an operator, you're buying crane services, you're not renting a crane. That would affect the taxability. That's not really something that you would typically be deciding. You'll just get a different invoice from the rental company.
We use cranes for doing like putting air conditioning units on top of the roof and all that stuff, but they buy the 9 hours plus the.
Well, that presumably, yeah, the way you're describing it, I would think the whole thing is not taxable. If somehow you're renting the equipment from Joe, and Bob is supplying you with operators, then you might be renting equipment from this company, and you just have non-taxable operators coming from another company. But the same people are providing you both.
They own.
Yeah, I would expect they're not charging you tax. Yeah.
So like our sister company, the demo company, Dallas office owns all the equipment. They're moving a lot of the costs of operating it down to the Austin office. That technically tax ID. That be a taxable situation where the Dallas office is
If it's like a true transaction, it'd be taxable. If it's some kind of bookkeeping, then I would say I'd be curious to learn the exact facts. But in theory, it might not be because you're just kind of doing something like that. But if this turns out to be a true transaction, and if someone gets in an accident, the other party's on the hook than the first party, then yeah, very well might, it's something worth. There's a risk there. I'd put it that way, and I would dig into it and see if you get comfortable with the answer. Yeah. It's taxable unless the lessee is then going to turn around and lease it to somebody else. But yeah. And again, if it's just an equipment rental, if they were supplying operators, then maybe it's just a service, non-taxable service. Is there another? All right, great. I think we talked about this, basically manufacturing exemption. You just got to do it right? You got to do a separated contract. So some of these slides just kind of summing up. I know it's a lot of stuff, so these are kind of summing up. So your purchases under non-residential remodeling. So let's remember, non-residential remodeling, that means you're not a contractor, you're performing a taxable service. So in theory, everything you buy, you're turning around for resale. Does that mentally make sense? So then kind of going down the checklist. So any materials, where you're going to turn around to resell those, so those you could buy exempt. Any taxable labor, again, you could turn around and resell. Consumables, equipment, and machinery, we talked about, those are always going to be taxable, kind of no matter what to you. Any real property services you purchase, just like this, exempt for resale. And that's kind of it. So this last line, just remember, you can do it if you do a lump sum under a non-residential remodeling. Well, you're not a contractor, right? You're just a service provider. So even the idea of the term lump sum contract kind of doesn't mean much, but kind of doesn't matter, right? Because all the materials are taxable and all the labor is taxable. So who cares if you break out labor and materials? The whole thing's taxable. Now, if you're doing work as a contractor, whether it's new construction or residential remodeling, in that case, at least in your head, you should be thinking, all right, under new construction, none of the labor is taxable, but anything that you purchase as the contractor under a lump sum contract, would be taxable to you. Any consumables and equipment are always taxable to you. And I touched on this, real property services, they're not taxable if it's for residential new construction or you're passing them through under a separated contract. And that's really it. So subcontractors, I guess we're all subcontractors here. So, again, a subcontractor is just a contractor for all of the definition purposes and things like that. But each contract is kind of looked at in a vacuum, right? So the contract between a sub and the GC could be lump sum, and then the GC and the project owner could be a separated contract. One has nothing to do with the other, and the consequences of one, have nothing to do with the party who's, not involved with that other thing. So each contract governs all the parties' responsibilities. And I think I'm just kind of going through what I just said on there. Again, this is just summarizing all the various scenarios we've gone through. Separated contract with one party, lump sum with the other. So just kind of 4 variables. So these 2 slides go through those 4 possibilities. I'm just going to skip those unless you guys want me to go through it. A couple other topics, kind of on the miscellaneous topics section here. Taxes included. This gets people in trouble. There's a rule that says the amount of sales tax due must be stated on the bill to the purchaser, or there must be a written statement that the stated price includes sales tax. And here's the critical point. Merely saying all taxes are included does not get you off the hook for sales tax. Okay, you could just erase it and nothing different would happen. So if you show a total amount on an invoice and it's taxable, that whole amount is going to be considered to be the taxable sales price, even if your intent was that includes sales tax for some reason. That's a rebuttable presumption. So you can prove that's wrong by showing records that say, hey, we have this contract that says this amount includes specifically sales tax, not all taxes. So I have a couple examples of this, but I've seen this a few times. So you got to really be careful. A lot of times, I mean, it's like the same language in every contract. I don't remember it all offhand, but every tax, levy, this, that, and the other thing are supposed to be included. But it's not get you off the hook for sales tax unless sales tax is specifically on there. Okay? So here's an example where the language of the contract said the contractor shall pay all applicable taxes, yada, 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 and the comptroller just did not care, and they assessed, in this case, the the purchaser who was saying, hey, the contractor was on the hook for all this stuff. Comptroller just did not care. So that's that. So the next few slides, I just took a look. In Texas, there's courts and there's administrative hearings, and they all have various weight of authority to them. But basically, the comptroller gets to hear everything first, right? And usually the comptroller sides with the comptroller. But if you disagree, you could go to like a real court. But there's a whole administrative appeals process that involves going to hearings, which I do for clients all the time. So I just have a few examples here. I just went through like whatever past 6 months of cases and found a few interesting ones. So those are here. So these are all pretty much brand new. Like this one's just from a month ago. And hopefully these are all things you've already seen. Well, maybe not. Maybe there's some new issues here. So I take that back. Here's a case where the petitioner, meaning the person filing the appeal, they said, hey, we paid tax to our subcontractors, and therefore this amount you're auditing us for, we don't owe you. We've already paid it to our subcontractors. So really, a couple points here that came up of interest is that if you want to say you overpaid tax and you go to the state for a refund, you got to prove it, right? You can't just say it. You got to show you proved the tax. You got to prove you paid the tax and that the tax related to the transactions in question. So here's a case again. This petitioner said, "Hey, I don't owe you tax. I already paid it to my contractors," and those contractors came into two buckets of types, right? You paid to some subcontractors who were not permitted with the state of Texas. In other words, he paid Texas sales tax to a guy who, it turns out, did not have a permit to remit the tax to Texas. So by rule, by law, Texas says, I'm not giving you credit for that, right? Because that money's, by definition, can't find its way to the comptroller, so they're unimpressed that you paid tax to someone else. They want their money. So that makes sense. You're kind of no luck there. What about payments to the permitted subcontractors? And here, they would have to prove that the taxes they paid, well, let me go step back. So what the contract said, and you can read it with me, all applicable state of Texas sales and use taxes are included in this contract in the amount of X. This contract will supersede the proposal. And so what the judge said was basically, it says all taxes are included, but it doesn't define what taxes on what transactions and if that amount was correct. So the taxpayer was not able to prove any of that stuff, and so they lost. So again, you might think, hey, I paid tax to somebody, so I'm off the hook. Well, unfortunately, that didn't help this guy. There was another one with a bunch of different issues dealing with whether certain things were new construction. They didn't have a lot of good evidence, and really it came down to these 3 different contracts that they were arguing about. Might be more important, say, the lack of contracts, but jobs. Right? So in the first one, they were able to provide some old emails and a cost breakdown that showed, here's what it costs for the expansion of the parking lot to raw land at address X. And the judge said, all right, that sounds pretty clear, so the taxpayer won on that one. Here they tried to rely on an email from a prior audit period that a particular job was new construction, and the comptroller said, we're not bound by whatever they said. Who knows what they looked at? You can't rely on the findings of an old audit to support your position at a current audit. And then the third one, they couldn't find a contract, but they found an invoice to prove kind of the start date, and then they're able to find some Google Maps stuff that showed there was nothing there during that time period, and that was convincing enough for the comptroller. So despite everything negative I say, if you can in fact prove documentation to the comptroller, you can prove things even if there's not a contract or whatever the specific piece of documentation is they're fighting with you about. And there was another one, I didn't bring up this little bullet point, but there's one where the taxpayer lost a new construction argument, because if you went on the licensing division's website, if you looked up, the permit, it said remodeling. So that was a negative fact for them. But that could help you. If you go on that website, you might find that something was permitted for new construction, and you're missing other documentation. If that's all you got, show it to them, right? It can't hurt. And you might, in fact, win on that type of thing. The third one, the last one I want to talk about are these recent hearings. All right. So this one was, they got an estimated assessment because they really couldn't prove anything. And so the auditor came in and said, hey, your federal return shows you had $100,000 in sales, so we're going to say you had $100,000 in taxable sales. And so the taxpayer said, fine, if that's true, if I had all these taxable jobs, well, I know I paid sales tax to my vendors on these jobs, and you're charging me tax because they were remodeling. It wasn't clear enough. They were taxing the materials again. You're saying, hey, I should at least get a credit for the taxes I paid because I could prove that. Even though you're saying I owe taxes on the sales side, right? So they basically argued that, hey, if this stuff is estimated because I can't find my invoices, I should also get an estimated credit on my purchases, because otherwise I'm being double taxed. And basically the judge says no, because you couldn't really prove any specifics. You couldn't prove any records that tie any particular purchases to these specific contracts or projects. And then by definition, in order to get a refund / credit from the comptroller, you got to provide proof about those specific payments, and he couldn't do it. And so he did not get credit. So he did, in fact, probably end up paying tax on the materials and owing tax that he should have collected from his customers. So he got double dinged. So that is and then I have a little bit on working on exempt organizations. How's everyone doing? So I will finish this piece, and then basically I have a whole piece on what it's like to go through an audit, or 15 minutes on going through an actual audit. I'll get through this, and then I'll ask you guys if you want me to present on that, or you're good. All right, does that sound like a good plan? All right, so everything I talked about, just real quick. So if we go back to the beginning, this thing, you'll obviously forget everything I said in 20 minutes. But if you go back here, and when you could actually read this, everything on here should agree with everything I've said, and it's pretty good. It's pretty helpful. So I encourage you all to look at this, kind of remind yourselves about anything you forget from today, or if you have any questions for me, presumably because you can't kind of find your place on here, or it's a gray area. So we've basically done this slide, and then I'm just going to talk about this slide, which you can tell is much smaller. So I just wanted to remind you about that thing. All right, so I just want to talk about doing work for exempt organizations. So of course, we talked about this. Lots of entities are exempt because of who they are, right? The government, churches, charities, schools, things of that nature. So when you're doing work for them, any of the materials that are incorporated into the job for them should be exempt because they're for their use and they're exempt. Any taxable services that you buy that in order for you to perform your job for them should also be exempt. Because again, it's really for their benefit. Major caveat, and I've said it before, right? Any machinery or equipment that you rent, it's still going to be taxable to you. That is not going to change whether you buy it or whether you rent it. Consumables, we talked about before, those are typically taxable to you. However, when you're dealing with an exempt organization, you can, in fact, use those things exempt. And then it used to be that there's this one debate about whether fencing, silt fencing, was a consumable or not, because it was used once for the entire project. So is that one use? Is it consumed? So it was a gray area. Once upon a time, the comptroller said, no, that was all taxable. And now they say one project equals one use, then that's a consumable. That's what the rest of this slide is about. So consumables, you could get exempt for an exempt project. So instead of getting a resale certificate from them, you'll be getting an exemption certificate from them. It needs to be complete. If you could get a letter from the comptroller instead of the exemption certificate, that's fine. The government don't actually have to give you an exemption certificate, just their orders themselves are good enough because they're the government. Now, what about you? So when you go to buy stuff on behalf of this exempt organization, under a lump sum under a separated contract, everything's the same, right? You're going to give your vendor a resale certificate on taxable materials anyway, and you're just going to get an exemption certificate from your customer instead of collecting tax from them. So that's kind of business as usual. So what about when you have a lump sum contract with an exempt organization? You are by definition not allowed to give your vendor a resale certificate, but yet you want to buy this stuff exempt because you're buying it on behalf of the exempt organization. What should you do? Because I get this question a lot, is you should give the vendor an exemption certificate, not a resale certificate, the exemption certificate. Then basically on there, it asks, reason for exemption, and you should put, you'll be the purchaser, but when it comes to explaining the exemption, you'll say, I'm doing work for the Church of XYZ for Project Y. And that'll be your explanation. You'll give that to your vendor, and they should accept it, and that's how you are able to buy things tax-free for a lump sum job for an exempt organization. Yeah. Yeah, this comes up a lot.
We come up with that, yeah.
It does.
So we did a job, or one of our jobs is for the city of Irving. So they gave, city of Irving gave the GC, and we gave exemption based on purchase order and based on referencing the exempt city of Irving and but
Well, A, it's good enough if they don't tax you, right? Because we're not dealing with the state, you're just dealing with the vendor. So if you get them not to charge you tax, problem solved, right? And if they get audited and they decide what you gave them wasn't good enough and they come after you for the tax later, then you could have that conversation. So in my mind, you're good as long as they don't charge you tax. But I think that is correct, period. I think that is correct.
So we will not give a resale to our vendor because we have an exemption by it trickled down.
Right. So that would assume that you have a lump sum with your GC, otherwise they would have given you a resale certificate. It doesn't really matter. I'm just being precise because we're right. Right. Well, if they give.
Do we give our vendors the subcontract?
You should give the same type of certificate you got from the GC.
Okay, so that was our.
Yeah, exactly. I think you did exactly right.
Question came up, and give us an exemption. And I did ask for an exemption certificate they got from the city.
Right.
So the city has an exemption certificate. I have a copy of it, and then they gave us their exemption certificate.
Yeah.
Our vendor.
I think you're 100% in the clear. Yes, ma'am.
What
Yeah, I mean, so
Because when you, if I'm talking about the but that's always been
yeah, I mean, I would say the same thing, that I would give your vendor the same certificate you're getting. So if you're getting a resale certificate, I give a resale certificate. But just to your point, or to push back a little, is so you're acting as an authorized representative of the exempt organizations. That's why you put your name as the purchaser, but then for the job itself, you would describe the exempt organization and the project itself. So, it's really two goals, right? You got to get your vendor not to charge you tax, and then you also got to be good on audit. Yeah, a lot of this is like semantics. I just want to be 100% correct with, in the wording environment. But basically, big picture, if your vendor doesn't charge you tax, then you're good. Yeah, exactly. Did I see any other?
I do have a question.
Yeah.
Okay, it's kind of in the same vein, but a little different. So if we have a subcontractor, the GC or whatever's doing work for a nonprofit, if their resale form to me has to be from the GC, right? They can't walk in and bring me like, well, this is St. Jude's, whatever, exempt form, and they just pass it to me because I'm not dealing with St. Jude directly. I'm dealing with the GC. So don't I have to have that form from the GC?
You have to have a form from the GC, and which form you would get is really based on what kind of contract they have with them. So they should either be giving you this, just like I described, and it would just go up the chain as an exempt. I'm an authorized representative. I'm an authorized representative up the chain, or resell up the chain. So whichever one kind of works or is accurate, but kind of the foundation is, the beginning is the GC and the exempt organization. If that's a lump sum contract, then the GC has to give, technically, the GC has to give you an exemption certificate. If that was a separated contract, they would give you a resale certificate.
But the GC has to give me a paperwork. They can't just walk in and go, here's
Right. They can't just give you St. Jude's exemption certificate because you don't know that their project is related to their charitable purpose. And, there's really, technically a charitable organization can do things that are outside its purpose, and those are taxable. So, it never really happened. Yeah. It's kind of part of all the good faith thing, right? You just got to, yeah. Right. Which kind of piece of paper that is can vary. And then I would just mimic that up the chain. I mean, I think we've kind of talked about all this stuff, or hopefully it all just makes perfect sense. Now, here's some random examples of stuff. Porta potties for you to use while you're on a job are taxable. They're not for the benefit of, the exempt organization. I'm just going to kind of frankly just skip over these. Here's some examples. You guys can look at. Any questions, you can let me know. I'm just going to kind of skip those. So let me cruise through these. It's only a handful of slides. There's an exemption out there for work on historic places. So labor to restore, repair, or remodel historic places is exempt. So if that's limited to properties that are listed in the registry of historic places. So if you're doing that kind of work, you would just need to get a relevant exemption certificate, and they would explain historic place exemption. There's also a franchise tax credit if you're doing work on those types of places. Disaster areas, otherwise taxable labor charges in a disaster area are not taxable. The exemption only applies if the damage was caused by the disaster, right? So if Houston's a disaster area because of Beryl, then you can't go and fix stuff from 2 years ago and just claim the exemption. It has to be related to the damage caused by the disaster in question. By definition, the disaster area has to be declared by the governor or the president. And again, you need a piece of paper to support it. This is just a note again, form over substance here. So even if you have transactions between related parties, everything I said applies, and just, be careful because there could be tax consequences. Local taxes, I think we talked about this as well. If anything I said, scares the bejesus out of you and you have a huge exposure with the state and you're terrified they're going to knock on your door, you could come forward and do what's known as a VDA, a voluntary disclosure agreement. The way it works in Texas is if you come forward, they reward you and they'll say, hey, if you're a non-filer, they can go back to the dawn of time. There's no statute of limitations. So if you do a VDA in Texas, they say, we'll only go back 4 years. We'll waive all penalties. And what's unique about Texas, most states won't do, is they'll waive all interest as well. And you could even arguably do this under a payment plan. So it's just something to keep in mind if applicable. And I think that, I just had a note on telecommuting, which has obviously become a much bigger deal in the last few years. Not such a big deal in the construction industry because typically you're only earning income from the state if you have a job in the state. But just keep in mind, if you have an employee working in another state, that has tax consequences. The company may now have an income tax or a sales tax filing responsibility in that state. Sometimes if you're there for less than 30 days, or you have a worker there who, dollar-wise, it's almost impossible to have a full-time employee without triggering all this stuff. But there is a grace period typically, and just something to keep in mind. So if you want, I can talk about going through a sales tax audit. Take about 10 minutes, but I will pause at least and see if that sounds like fun to everybody or you're about done. Who wants to hear about sales tax audits? Raise your hands. All right, you can let everyone leave and you four can stay and we can have a... it's going to be 2 minutes. Let me see if there's anything particularly interesting. Lots of audits. You'll get a letter in the mail, at which point... All right, well, I don't know. I don't want anyone to feel obligated. Well, they didn't want this. But I will go.
The only thing worse than hearing about sales tax audit is not hearing about it yet.
All right, that's a good point. So I'll just kind of go through this slide. This is, basically the, the outline instead of going through all the details. Basically, first you'll get a letter, and they'll just kind of want to know, hey, where are your records kept? What do you do? Who are you? Don't ignore us. And if you go through that process, then they'll reach back out with, the actual auditor will call and say, hey, I'm Joe, and here's a list of all the information I want. And typically, they'll give you a pretty generic information request letter. I think I had one in here. No? I thought I had a copy in here. Well, here's the list. Oh, here's the list. So this is 2 slides. 2 slides of stuff they're going to ask you for. A lot of times they'll ask, they ask for everything in the moon, and you might not even have half these things, and that's fine. But big picture, obviously, you can imagine the contract world, the construction world, that flow charts everything, right? They're going to want to know all your jobs. They're going to know, ideally, a copy of all the contracts. So then they'll determine if they think these things are lump sum or, separated contracts. So obviously it could get complicated if you're doing multiple different things. But an audit will kind of be broken out into a few different parts. Of course, they're going to review your sales for sales tax. They'll also review your expenses for, sales tax that you should have paid your vendors. So the big thing in expenses, obviously it's all kind of the commonsensical stuff, but there's a few pieces of low-hanging fruit in Texas. For example, janitorial services are taxable. So if you got some cleaning person cleaning your office, there is a greater than 0 chance they're not charging you sales tax. Every auditor will go and looked a dingy on that. But probably so they'll do your expenses. If you're a large company, they won't look at every expense. They might do what's called a sample. They'll look at 10% of your expenses and then say, all right, we found this 10% resulted in 10 grand in tax, so we'll multiply that by 10 and we'll estimate you owe 100. So they could do a sample of your expenses. They'll also want to look at all your fixed assets. They won't do a sample of your fixed assets. They'll want to see an invoice or an explanation of why you didn't pay tax on every fixed asset purchased during the audit period. And then this one is often a lot of work. What they'll also do is they'll try to figure out, can they trust your books, basically, and they'll do what they call a reconciliation. They'll look at the revenue you reported on your tax returns, like federal and franchise tax returns. They'll compare that to what you reported on your sales tax returns, and they'll look at your sales tax payable account, and they'll line all these things up and say, hey, why was, if you paid $10,000 in tax, they'll expect, my math is right, well, should I do that? 82,000? No, that's not how it works. But if they see 8250 in tax, they'll expect to see that you had 100 grand in sales. But wait, you reported $200,000 of sales on your federal return. What happened to this other 100,000? I don't know. Let's just assume it's taxable unless you could prove otherwise. And so that's basically how it works. They'll do a month-by-month reconciliation. Hey, your sales tax payable is X. Y shows you collected more than that or something else. Explain that, or you owe us tax. If there's anything that goes the other way, where it's a credit to you, it looks like you overpaid, they don't care about that. You don't get credit for that unless you could explain it. So that's a reconciliation. That's kind of one of the first things they do, and that often leads to questions. And a lot of times there's good answers, right? This is an adjusting journal entry, this, that, and the other thing. But nonetheless, the auditor doesn't know what they don't know, so they're going to always do this reconciliation kind of up front. So look at your sales, and and then they'll look at your purchases, and then I don't want to spend too much time on anything particular, but as far as things you can do, if your business is one that involves collecting certificates, you should go home or go back to the office and start making sure you have all those things, and to the extent you have them, make sure they're all filled out, they're all signed, they all have the taxpayer number on it, yada, yada. You could fix these things during an audit, and they give you lots of time, but people go out of business. You end up getting in fights with your customers, right? I mean, there's a host of reasons why it'd be a lot better to have this certificate now than trying to get one in the middle of an audit. Consider having a third-party representative help you out. Thanks to Donna, we've talked about that a little bit. You could have the auditor come to that representative's office instead of your office. And again, we kind of talked about that. There's this thing called the managed audit, where you kind of do the auditor's work yourself, but you got to jump through a bunch of hoops for that, and I'm just going to kind of skip over that because that kind of never happens. So let's just get to the part where you disagree, right? You went through the audit. They say, hey, all these things were new construction or not new construction. You say, yes, they were. You can't come to an agreement. So ultimately, before they send you a bill, they will offer you this IARC, Independent Audit Review Conference, where basically you and the auditor go and have a conversation in front of someone else, and you give your sides, and then that someone else gives you their opinion and see if they can resolve the issue that way. Well, that's someone else. That's just another auditor. So I've been through a few of these, and I've never had one that was helpful, but nonetheless, this is more like a black and white issue, or, this document says X and this person just refuses to listen. Like something like you could just black and white prove something. But if you're going to argue some concept of law, or, just this makes, I feel like I'm more persuasive than the other side, this is not really the venue for that. This is really more just clerical stuff, or, hey, I got this piece of paper 2 weeks after the auditor was done with their work and they refused to listen, stuff like that. But ultimately, there's a lot of reasons why the audit might be wrong, besides kind of obvious things. One thing I point out is, if it's the type of thing where, hey, just because you didn't pay tax on a transaction with X, maybe X got audited and paid tax on it. and tax is not owed twice, and you're off the hook. So if you have an audit and there's a lot of money involved with a particular other party, whether it's your vendor or a customer, a customer, it's a little bit different, right, of course, but it's very possible that somehow someone else has already paid that tax, and then depending on the facts, you got to provide proof that that in fact happened. Stuff like that. But basically, once the audit is done, they'll eventually send you a letter, and then you'll have 60 days to protest. You never have to. You get the letter, it says you have 60 days to pay the assessment or protest. If you choose to protest, you don't have to pay a dime until your protest is all the way done, which could be years, literally years. And then at that point, if you still disagree, then you have to go to real court instead of the administrative hearings. Texas requires you to exhaust all your administrative remedies first before you go to court. So you can't, a lot of this is kind of a losing battle, right? First you deal with auditors, and then you're dealing with administrative law judges, who they kind of also work for the comptroller's office. So you're still kind of, you're not getting a totally neutral party ever hearing you. But the good part about protesting, again, is you never have to pay until it's all done. Of course, interest continues to accrue, so you can pay or pay some of it to mitigate that happening. I could go into a little more detail about that appeal process. You have 60 days. If you do decide to protest, you write a letter explaining your position. Then they come back and they say no. And then you get to write another letter saying, yeah, but this. And then they get to write you another letter that says no. And then you go before that administrative law judge I was just talking about. So all that stuff could take a long time. And sometimes just that has value to taxpayers as well, right? Just dragging this stuff out sometimes. I'll flip to the slides and see if there's anything else more interesting, but I know you had a question.
What you said, audit and notice something with one of your vendors, and they say you're not paying enough tax on a rental company. They can look at the cost and the tax. They're looking at the invoices. But yeah, tax is not right. And so, and it was just one rental company. We're paying what they're billing us. We don't know. We're not a rental company. And so we contacted the rental company and said, hey, tax we're paying. Actually, we're going through an audit right now. Our system, when we changed it over, wrong amount. Our auditor, he goes, ask him who the auditor is. The auditor's information. Call him to verify. Whole vendor off.
Yep. See? But you wouldn't know any of that. Right, and you wouldn't know anything unless you reached out to that other vendor.
We wouldn't have known that we could have gotten hit for all of that.
Right.
But because, what's going on here?
Yeah. Then the flip side is, I should have collected tax from all you folks, but, it's going to piss you off and you're my biggest customer. Do I really want to come after you?
We had that conversation
right.
on the side. And
so, yeah.
That's our fault.
Right. So you got the good result. Yeah. But that's.
It was all good. Regular thing on your invoice. Your vendor gets upset because you call and ask them.
Yeah, I mean, I've just every kind of possibility out there, right? Like, right. Or sometimes the vendor, for example, was audited, and they won't respond to you. It's like, well, or best, sometimes it's like, help me out, or I'm going to tell the auditor, they should come after you next type of deal. Like, there's all sorts of things out there. Every fact pattern possible is, will happen. I think that's really it. So I will stop there unless anyone has any questions, comments. Yeah. Is it exempt? Is that your question?
Well, do we pay tax or not? Because it is required by the GC because of OSHA.
I don't think there's anything that gets you off there. If you're a manufacturer, you get a PPP, personal
Yeah.
protective, whatever. But I don't think that applies to everyone always. I think that's just in the manufacturing context, as part of the manufacturing exemption. I don't think you get an exemption, but if you want to email me, I can answer you with certainty. I don't think you do, but I don't want to say with 100% certainty just because I'm not 100% sure offhand. But I don't think, again, you get an exemption unless it's manufactured. Yeah, if they're not taxing you, accrue it, yeah.
I was just curious
I don't think it's exempt just because it's government required. I think, again, part of the manufacturing exemption, I think you're involved in what's defined as the manufacturing process, then protective equipment and things of that nature, you do get exempt as a manufacturing exemption, but if you're not a manufacturer, I just don't think there's something there. Donna? That's true. Then Texas will want him to pay use tax at the job site. And he gets a credit for any taxes he already paid, which of course is 0. So yeah, so that will not get you off the hook. Same if you buy an airplane. So a little more tax involved, but that comes up a lot. So yeah, the use tax can be, there's a whole bunch of stuff on the use tax front. Like you were talking about, you accrue it. So just to be clear, if you're buying stuff that should have been taxed, or let me rephrase it, hopefully someone at your company looks at all your purchase invoices to make sure tax was paid, and if it wasn't paid, was there a good reason, or should you be accruing and remitting use tax to the state? So just as a matter of good procedures in place, hopefully that's happening, because that's how you handle it. If someone should have charged you tax and you didn't, you accrue and remit use tax to the state. And if you don't do that, of course, you get 48 months of it at one time if you get audited. All right, well, I'll hang up for a few minutes if anyone else has any questions, but otherwise I will stop talking. Thank you so much for your attention and involvement.